He is not present in the House, so Honourable Minister.
Thank you very much, ma'am. Thank you, and I thank all the honourable members who have very briefly but obviously raised very critical issues about this bill, which is seeking the acceptance of the House and to get passed. I'll try to address as much as all the questions that have been raised, but largely on many critical issues, I find members have referred back to the initial questions posed by Honourable Member Jairam Ramesh. So the 12 members who have spoken today and the issues that they have raised largely evolve or reel around the critical questions raised by Member Jairam Ramesh. But before I respond to the important questions raised by Jairam, I would like to just very quickly tell about the institution itself. Honourable Chairperson, sir, this is definitely a unique institution. Whilst India has always benefited, irrespective of party, politics, government, which is run by this party or that party, India has always benefited by the various institutional mechanisms which have been created every now and then to either with the statute or outside of it. They've all been created to benefit and to service the needs of the time which they've serviced and for which they have come out. So as the institutions were set up and as they contributed towards India's developmental requirements, and as time passed by, when their character and the references made to them also had to adapt and change accordingly. So some changes were coming in and some adaptations have happened. However, as one of our honourable members observed, many of them have outlived their time. So we have to obviously learn lessons from all of them, but yet not be so close-minded about, well, we've tried that earlier, today why should we go back? Need not be a handicap. On the contrary, sometimes when it is necessary, we may have to go back to a setup, which is, in this case, a statutorily backed institution, which many of the countries in the West, which are, if I can use loosely the term, which are very capitalist in nature, have also adopted that a parliament-backed institution will have to give that kind of a heft for institutions which are funding development. So we are not doing anything in the sense of decrying institutions which existed earlier, but now going back to doing the same thing. It is clearly the need of the hour and need of the next 25 years in India's developmental story that we need an institution with that kind of an architecture which has both the strength of the government backing it, at the same time being able to face the competition in the market. This act itself, as you would have, all honourable members would have recognized, gives space for private institutions also to come up, for whom we are giving the tax benefits for just 5 years of the first 5 years, whereas this institution gets the tax benefit for the first 10 years. So therefore, we have learned from the earlier experiences, and therefore we've designed it in such a way that it has the blend of both. And I'll just go back to underlining the need, establishing the need as to why we need an institution of this nature. Now, 2019 budget had this budget announcement of 100 lakh crores which will be invested for infrastructure over the next 5 years. By that year end, we came up with a national infrastructure pipeline which had more than 6,000 then, now which has grown up to 7,000 such projects, all of which relate to infrastructure, and infrastructure just not roads and bridges, but the definition of what constitutes infrastructure is also something which I very quickly want to refer and inform the members. There is an April 2016 notification which is also very clearly identifying of the infrastructure subsectors. Many of the members said, what is it? Infrastructure means only the roads and bridges. The transport, energy, water, communication, and water sanitation, communication, and social commercial infrastructure are well defined. So this institution will fund all of those activities, and it is not going to be just confining itself to bridges and shipyards and ports. Social infrastructure includes educational institution, so the capital stock of the institution will be treated as infrastructure. Hospitals, again, capital stock will be treated as infrastructure. So these are also part of what is defined as infrastructure, which this developmental finance institution will fund. So this list itself is rather self-explanatory about how expansive this institution is going to be looking at in terms of the field for which it is being created. So then, from among the lessons learned is the fact that development finance is highly risky an area. It is long-term in terms of gestation, and you also need higher credit costs to be calculated, and therefore the failure possibilities also become a part of the calculation. And therefore, this is an area in which, like the way we've seen in the last decade or so, regular scheduled commercial banks entering this domain always creates asset liability mismatches, because these banks borrow short term and lend long term. As a result, there's always going to be an asset liability mismatch, which is not going to be good for the financial sector. So the other point which is very clearly got to be recognized even at the beginning is, it is not as if we are dependent only on FDI. It is not as if we are dependent only on sovereign funds which come to invest in Indian infrastructure. I agree, Indian infrastructure will have to be funded even by Indian savings, Indian investments. But to create Indian investments, or to create an ecosystem for Indian investments to be able to invest in building infrastructure, the ecosystem will have to have some kind of a institutional arrangement, which is what I said in the budget, and rightly it was pointed out by Jairam Ramesh. And I will give a separate answer for that as to what is that institutional mechanism which Honourable Member raised as a question, saying what is that institutional mechanism which you think you're going to be bringing in, both for deepening the bond markets and also for funding infrastructure. For funding infrastructure, I'm speaking today about this statutory All India financial institution that we are creating, which will have both developmental and financial objectives. Developmental is that it shall be the provider, that it shall be the enabler, and that it shall be the catalyst for the ecosystem of infrastructure funding. It will also support every attempt to deepen and to bring in more liquid bond market of international standards. It will facilitate the development of derivative markets and also other innovative financial instruments. So on the financial side, very clearly it will be the institution which will lend for infra projects, and more importantly, it will establish a credible framework for both equity and debt investments. It will attract investments from both domestic and global institutional investors, as well as domestic retail investors. So we are not just depending on FDIs. So we need to recognize that we have made a provision for leveraging both the capital available within the country and also through the global institutions. Ownership, very quickly, all of you all have very clearly read that and spoken about it. We start with 100%. Eventually, sometime, long time afterwards, it will come down to 26, but there will always be 26% presence of the government at all times. Very quickly, also on the governance structure and management, it will be professionally run. The government will appoint only the chairman, but the institutional arrangement for the appointments of members or the MDs and the DMDs will be done and recommended by the Bank Board Bureau, the BBB, and it will be vetted and finalized by the Nomination and Remuneration Committee of the board. So the appointments will be done by the board and not by the government, so it will have to be professionally run. And all the safeguards have been provided, and on that point, a lot of members have raised this question saying, you have given them safeguards, you've given them far too much of safeguards, they are not going to be answerable to anybody. I will definitely answer that by going back for a minute to clause 26, if I remember correct. Clause 26 in chapter 6 of the Act itself, which is before us for consideration. And there you will see in paragraph 5, and I read that as a quotation from here, the institution, which is this institution that we are considering today, the institution shall furnish to the central government and the Reserve Bank within 4 months from the date on which its accounts are closed and balanced, a copy of its balance sheet and accounts, together with a copy of the auditor's report and a report of the working of the institution during the relevant year. Honorable Member Satish Mishra did raise why only 5 years. No, every year. But the report later by a third party is on once in 5 years. But here we are saying every year. So the working of the institution during the relevant year, and the central government shall, as soon as maybe after they have received by it, cause the same to be laid before each house of the parliament. We are getting that report, audited report, to be placed in each of the house of the parliament. Now, the institution shall furnish from time to time to the central government and to the Reserve Bank of India such returns as the central government or the Reserve Bank may require. Every time the government would want something from them, they will demand of it, and it will have to be submitted by them. The point that Honorable Member Satish Mishra raised was for a third-party assessment about their whole, functioning, which can be done once in 5 years, is what we have said. But otherwise, every year audited account comes to each house of the parliament. I want to absolutely state that upfront. It's part of the Act itself. We are not saying we are going to bring it in the rules. It's made as a part of the Act that this shall come to the parliament. Resource raising capacity, we've already spoken about it. I understand Jairam Rameshji talking about the capital, that we have provided the authorized capital of 1 lakh crore, and 20,000 is the equity we've given, and about 5,000 crores is given as grant, so that they can immediately start looking at ways in which cost of funds can be brought down, so they will have something in lieu of potential cost savings expected from the issue of a tax-free bond and so on. The issue again about sovereign guarantee. I want to just underline that yes, a sovereign guarantee is being provided, but that is only, that's the provision provided under section 17(3). It's an enabling provision with the decision to be taken by the government. So it's not as if it's blanket, it is an enabling provision which is mentioned under 17(3). So resource raising capacity is something which is very clear. Priority sector lending shortfalls, we will take that also on board. Access low-cost funding even for the priority sector lending, which sometimes suffers for want of resources, even that will be addressed by this. Even better, this institution will be able to access the line of credit from RBI. Therefore, it will be possible for it to very quickly meet up the demands, particularly from the social sector, for creating the infrastructure in that area. Other notable features of this bill, sir, which I would want the honourable members' attention drawn, are that the framework to enable RBI to issue licenses and issue regulations for granting of licenses for other infrastructure focused DFIs in the private sector is also provided for in this law. So what will happen is RBI, if it finds an applicant meets the regulation as stipulated by it, is completely compliant, they will be in a position to consider issuing licenses. So there will be, for healthy competition, creation of DFIs in the private areas also. As I said earlier, they will be exempt from tax for 5 years. The institution and other DFIs will operate within the prudential framework of RBI. This institution shall also have that role of an institution to resolve disputes which may arise in the field of infrastructure funding. So broadly, the character of the institution is, as I described here. Specific issues of concern which were raised by Honorable Member Jairam Ramesh, which was referred to by many members, is this is not beyond oversight. The reports every year are going to come to the House of the Parliament, both houses. Audited reports are going to come in here. And as and when the government is going to ask them for a report, they are duty bound to give it, and it shall come here. So Parliament's oversight annually is envisaged and built into the Act itself. So that question definitely gets answered. There was this question about, it's all right, you're looking at funds coming from elsewhere. What happens to incentivizing savings within the country? How are Indian savings going to be? So DFI will need long-term funds, and that is well recognized. It will therefore have to be able to issue long-dated paper domestically, and which in turn will encourage domestic savings. And with this said, I now go to that point which again Jairam raised about my budget announcements. I want to read that from the budget. To instill confidence among the participants in corporate bond market during times of stress and to generally enhance secondary market liquidity, it is proposed to create a permanent institutional framework. The proposed body would purchase investment-grade debt securities both in stressed and normal times and help in the development of bond market. This is what I had said in the budget. I'll just explain as to how this institutional arrangement is being envisaged. Mutual funds, as we know, sir, account for 60 to 70% of trades in corporate bond market. Commercial papers and certificate of deposits thereby facilitating fundraising by issuers who are banks, corporates, NBFCs, and also Housing Finance Corporation. A cardinal principle of mutual funds is liquidity. Their liquidity depends on liquidity of their invested instruments, particularly corporate bonds. However, liquidity, illiquidity, and market freeze is particularly dominant in corporate bond market, especially around stress times and distressing selling by mutual funds, leading to a contagion effect. We saw recently how, because of one of the mutual funds having a genuine problem, it had a very rattling effect in the market. So, sir, there is clearly an advantage, which all of us recognize, in moving to the bond market from a bank finance-led model to avoid asset liability mismatch, issues which arise out of it, transparent pricing, and also to take more market-oriented systems. And that is why, as the financial sector evolves from a bank-dominated system to a more market-oriented system, supporting financial markets become an important aspect and important step which the government has to be responsible about. Hence, a permanent arrangement mentioned in my budget, a permanent arrangement of an SPV facility is considered for providing liquidity so that they can act as the buyer of the last resort during stress times, and to some extent even acting as a market maker during times of peace. The SEBI, therefore, will be setting up a fund titled Corporate Debt Market Development Fund, CDMDF, which will be set up as an alternative investment fund to provide this liquidity facility to mutual funds and other participating institutional investors in the corporate bond market. This essentially means it will function as the buyer of the last resort for stressed corporate bonds which are of investment grade during stressed times. So the key mandate of this particular facility, which the SEBI is creating as a fund, development fund, trading will be one of it, trading in corporate debt with a focus on below AAA rated papers. But however, those papers will have to be of investment grade during non-stress periods. And the second and the final is to have capability to buy and hold single or a basket of corporate debt securities from secondary market during times of systemic stress. We saw that happening during late 2019, and also when liquidity was an issue, when NBFCs were sitting with a lot of papers which were not even investment grade. There was a lot of effort put by the government together with the Reserve Bank to sort that out between the NBFCs and the banks. That experience has been teaching us a few things, which I'm glad the SEBI is addressing in this form, so that they will have a given formulation to address such stress during stressful time and during peaceful times, how to handle it. So the SEBI is working out the operational details of this facility in consultation with the Department of Economic Affairs. The special SPV is proposed to be jointly set up with the contribution of the mutual funds and also other institutional investors. However, the majority ownership shall be with a subsidiary of a public sector mutual fund. So that's the arrangement, in short, which was indicated in the budget speech. Sir, I think also one other issue which I would like to draw the members and their I would like to draw the attention of the members and for them to take cognizance of. And this is a very interesting aspect which SEBI had mentioned to me even during the COVID period. There is naturally a tendency now, particularly the savings which comes out of middle classes, to not be risk averse. So they don't mind moving out of post office savings or bank savings into the stock markets. They are looking at very credible, well-listed, transparent, board-driven decision-making companies and directly investing in them. So Indian savings is not purely now dependent on risk-free public sector savings. It's also moving into the stock market. How do we establish that? I've got a month-by-month data in the year running from January 20 to February 21. The growth in the number of demat accounts opened during the month, demat accounts of which 99% of them are, of these demats are individual category accounts. So they are not large funds which are investing, but the demat accounts here that I'm telling you is of individual category accounts. If in January 20 there were 6,30,292 demat accounts opened during a month, that today is gone to 17,88,654 individual accounts. Now, if this is during the month, they obviously open and shut, and end of the month is the indicator that we take. There has been a 27% growth in the end of the month account, that which continues to be there. February 20, sir, there were 4,1,29,252 demat accounts at the end of the month, which means they continue to be there, which today has reached 5,31,14,800, a 27% increase, which means today Indian savings indicator is not just that which goes into savings accounts which are risk-free in the banks or in post offices, but they're moving towards directly engaging in the stock market with listed stock shares which are open there for everybody to see. Many of them may not probably even go through the mutual fund routes. So these are the ways in which the savings attitude of the Indian citizens are changing, and unless institutions make provision for it, like the way the SEBI is thinking in terms of a fund, like the way this DFI is coming up, like the way the NIIF is, the National Infrastructure Investment Fund, all of which have a chance, and like the way, I take this opportunity, LIC funds infrastructure, no doubt, rightly pointed out by many members. But LIC should also now be accessible for that retail investor who wants to invest in them. So this IPO is not for government to get out of it, whereas to make more Indians participate in it, to put the money, a very large amount of what LIC has today is policyholders' money. Whereas when individuals want to become owners of it, they are being given an opportunity by the IPO so that they can invest. So to have policyholders' money is one thing, but to have Indian retail investors to become owners of shares of LIC is a totally different thing. So I think we have to recognize both these much before we even think in terms of, oh, what's happening? Is it all getting privatized? No. Many of the IPO owners which are going to go to the retail investors are making retail Indian owners to become part of the LIC's ownership framework. So, sir, these are the broad features. I think I've answered many of the members' concerns. One last point which Honorable Member Satish Mishra raised, private versus public. Treatment is not at par, obviously. I can't give everything that I give for a government-run DFI to a private institution. I give the initial 5-year tax incentive only because I want more funds to come to them also. It shouldn't become I've created a government institution with all the, let's say, lollipops, and the private one doesn't have any, and therefore they are not getting equal treatment. I've extended the tax benefits for 5 years, but after that, they should be smart enough to become competitive enough. I think I've answered why 5 years. I didn't notice that. You may want to. Can I please take the liberty of writing back to you on it in detail?
Where CBI, etc., all agencies.
Oh, that is why I said.
No, in the third proviso, second proviso, it is said that within 3 months, the competent authority will give the approval, extended by 1 month. With reasons. But third proviso says if it is not given approval within this time,
I get you.
It will not be required. So that's
yes. No, I think I would want you to, yes, it very clearly explains that within a certain period you are expected to give the clearance. And if you don't, normally you have a positive affirmation saying it should be deemed as given. Here we're putting it the other way. It is not deemed as necessarily given. You take it within 3 months, otherwise, sorry, no, it's not happening. That's the implication. So with that, sir, I hope I've answered all the members' concerns.
Thank you,
and
Thank you, Finance
appeal
Minister.
to everybody to pass
The question is that the National Bank for Financing Infrastructure